Thank you very much for coming along to this Amati investor event. My name's Douglas Lawson, and I'm a director of Amati. I'm one of the co-founders of Amati, and I'm one of the fund managers of the VCTs as well. We hope that you find this a productive use of your time. We hope that this is something that you would like to see us do again in the future, and we sincerely hope that if we are doing this again in the future, with one eye on the Scottish independence referendum coming up, that we're not returning from Edinburgh clutching our passports next time we come down. Anyway, if you don't mind, I'll just give you a quick run through the agenda for the day. Shortly you'll be hearing from Luca Piperi, who is the chief executive of a company called DXI, which is one of our portfolio companies. After that, there'll be a demonstration of a video game called Elite Dangerous, which is the product of another one of our portfolio companies called Frontier Development. After that, we'll have a break for tea and coffee, and then a bell will ring, and if I could ask you to respond quite promptly to that bell and come back and to your seats, because we'll then be starting the hearing from our third portfolio company, which is called Quicksand, and then from Paul Jordan. So that will conclude the formal part of the day. There's then lunch, and for those of you who would like to stay for the afternoon, there's an entertaining program of events this afternoon, including Paul, who will be playing his own violin, the violin you see on all the annual reports. And Paul used to be a very accomplished musician, and we're all hoping that we're all hoping that he still is, but we'll find out this afternoon. My musical education finished at grade 1 recorder, so I won't be joining him on the stage. You'll be pleased to hear. So the aim of today is not to. It's not supposed to be salesy in any way. We're not trying to persuade you to invest more into the VCTs. We're not trying to persuade you to invest directly into the companies that you're going to hear from. It's really to lift the lid on what we do on a daily basis on your behalf in terms of managing your portfolios. And I hope that you leave with some confidence that we're doing this in a way that you feel is competent and capable. Before hearing from the companies, we thought it'd be a good idea if I could just give you a quick run through of the types of characteristics that we look for in companies that we want to invest in. And hopefully you could correlate these characteristics to the companies that are about to come onto the stage. And you can see and you can understand why we invest in them. So if I can split this into 3 broad themes, and those themes are, first of all, the management, secondly, what we call the fundamentals, and thirdly, the barriers to entry. So taking each in turn, first of all, the management. What we want in a management team is trustworthiness, competence, and alignment. So trustworthiness, clearly there's a bit of gut feel there, but that's something that we will get a feel from meeting these people and from speaking to people who have dealt with the management teams in the past. Competence, we can study their track records, and we, of course, do so. And alignment, how much time and how much capital have these management teams invest in the business that we're about to back, and are they truly aligned with us? In terms of the fundamentals, this is really the numbers. And 2 of the 3 people in the team that manage your VCTs are chartered accountants by background. And whilst that might make us very dull individuals, it means that we take a very forensic approach to looking at company accounts. And the specific things that we're looking for are the growth capabilities of a company. And clearly, if you're investing in small companies, you're taking incremental risk, and you would therefore expect a superior return. And the best way of generating that superior return is superior earnings growth. So we want to understand what it is that can make that company grow and why its growth rates are greater than average. The next thing is the balance sheet, and we'll typically invest in businesses that have either no debt or very modest levels of debt. And the reason for that is really twofold. The first reason is that by definition, smaller companies are riskier and they're perhaps more susceptible to one of their customers going out of business or some kind of shock happening. And what we want to make sure is that our downside is protected insofar as that's possible by a strong balance sheet so they can withstand those shocks. And secondly, our view in general is that small companies should use the cash they generate to grow the business rather than service debt. And on that point, the third thing we look for is cash conversion. And you would be, you may not be, but it often astonishes us how many companies don't turn profits into cash. And so that's something we look at very closely, and we try to understand why that is. But in most cases, if a company isn't turning its profits into cash, then it's quite simple, we'll avoid it. Then there's the valuation. And the most common means of valuing businesses in the public company arena, which I'm sure you know, is a price-earnings ratio. And we don't mind paying a slightly higher price-earnings ratio for a company if we believe that that can be justified by its growth potential and by the quality of the earnings in that business. So we don't get too hung up on the PE multiple of the business. And of course, the beauty of investing in this area of the market is often the growth potential of a company is overlooked because it's ignored by the market. And that means that the stock we may deem the stock to be unfairly priced on the downside, so we see an opportunity there. And then finally, we look at the margins of the business, the profit margins of the business, and how sustainable are those margins? Will it come under pricing pressure on the top line? Are costs going up? What will allow that business to sustain and perhaps improve their margins over time? And that brings me on to the third broad area, which is barriers to entry. And that's related in part to these margins. And what we'll look for in a business is a product or a service where they're not competing on price, because usually a big company will always be able to win at that game. So we're looking for intellectual property or know-how or a brand, something that we feel will allow that company to continue to be competitive and to endure into the long term, because we want to back companies for the long term. Now, we invest in three situations. The first is companies that are already listed, or those that are in the process of listing on the stock market. The second is what we call pre-IPO investments, and that's where we see companies that we believe are about to list in a short space of time, usually within 6 months. And the third, and the most unusual type of investment we do, is an investment in a private company where we think there's an exit more into the medium term, and we define that as before 24 months. DXI falls into that third category. So it's quite a rare type of investment for us to do, but we felt very convinced about the potential of this business. And we think the prospects are very, very exciting for this business.